We are live. We're issuing a buy the dip alert. I believe the pain is just about over. I'm going to go ahead and start off looking at some drawdowns in Bitcoin on this first screen, and we'll take a look at the macro backdrop. But we can see, unless you go way, way early in the Bitcoin days, there's been plenty of volatility. We're currently sitting at a 52% drawdown in Bitcoin and Ethereum. So is it possible to go lower? Sure, but we really got to ask ourselves, where else would you put your money? I don't believe there's anywhere else to store value right now outside of the way we are currently allocated. So we're going to see what the Fed does Wednesday. My bet is they're going to start backing up on the hawkish talk, and then we're going to start seeing some lowered inflation expectations, which is going to be very, very bullish for how we're positioned. So it won't be long till we're buying the dip on NRGU and reducing exposure to the VIX. I don't think we're going to have the outright crash right now that many of you have probably hoped for while holding UVXY. So the Bitcoin market can deliver, in my opinion, a 200% return from here. And in the very, very worst case, a further 50% decline from here. So I like those odds, especially when we look at the landscape of slowing growth, deteriorating labor markets, deteriorating consumer retail sales, and we still got ECB printing money. China's getting ready to print money, and all we really need is for the Fed to slow down all this hawkish talk that they've been giving forward guidance on. But again, this is a remarkable sell-off when we haven't even actually done anything hawkish with policy. I'll show you the Fed's balance sheet just hit a new high Thursday, and we'll take a look at all the incoming data. But the worst start to the NASDAQ, I believe, in history to start out the year. And I believe this was primarily due to the interest rates on bonds rising too quickly, creating that volatility spike. We saw this early last year too. It created a similar period of volatility. But after it came through, we had interest rates falling and we had growth outperforming for much of 2021. So our high risk growth strategy returned 233% in 2021. And it's had a little drawdown in December, January. I'm going to show you proof. Typically after drawdown, we get the best returns. Now, if you're on a free trial, right now, your portfolio actually has 2 out of 3 positions up today, which is remarkable because there's very few things that are up on the day. And that is primarily UVXY, only up 5% right now. But when the S&P 500 was down nearly 3%, this puppy was up 25%. So you can see that was ready to go parabolic if there was more pain in the market. And we have stocks rebounding. Bitcoin and Ethereum have been rebounding before the stock market. And we're seeing that volatility index come down. So very critical FOMC update Wednesday. There was rumors they're going to end QE immediately, jump to 50 basis points and rate hikes on and on and on in the face of a dramatically slowing economy due to no fiscal stimulus for a year. So very good. We see this portfolio doing extremely well. And I do want to rotate out of BOIL into NRGU after it sells off a bit more. I think the Biden administration must knock the price of oil down so that they can pass their Build Back Better bill, which I'm still thinking is going to head to around April, most likely, because that's when I'm quite confident we're going to see the CPI falling. Now, if the CPI begins to fall sooner, perhaps they can pass that budget quicker. So right now, if you're putting $10,000 to work in our high risk growth strategy, you're buying 102 shares of UVXY, and that's a large position right now, but the markets are at critical levels, and there's a critical event Wednesday. Very confident the upside on your offensive portfolio can make up for any downturn in UVXY from here, and that's why we're going to go ahead and wait for confirmation on Wednesday if what I believe is going to be the case that they will backtalk all this hawkish talk, we can reduce UVXY on Thursday after the Fed meeting and announcement, which will come at 2 p.m. Eastern on Wednesday. And then again, I prefer oil long-term as our inflation hedge. We sold it at a high level and it's been selling off ever since. So I do think it can go down considerably lower before we will buy that dip. But today you have UVXY and oil up, and the only pain is in your Ethereum position. And again, right now you'd have 102 shares of UVXY, 256 shares of ETHE, and 115 shares of BOIL. UVXY is the outright stock crash insurance play. Ethereum is our tech play, which we call growth. Does really well if interest rates are flat or falling. And they can do okay if interest rates are slowly rising, but growth assets hate fast moving bond yields that rise. And we'll look at that data. And I can show you the bond yields are no longer rising, they are falling. So I do think the margin calls are what's causing this continued pain today, but that this is going to be wrapped and most likely the bottom is in. BOIL continues to protect us just in case that inflation is a little hotter than we've anticipated, and that it's going to stick around longer. And it's pretty impressive that oil is barely down to 85.92 on Brent oil after all this chaos and hawkish Fed policy. So that's the only thing that has me questioning what the Fed will do on Wednesday, because I do think their primary goal was to get those energy costs down, and all they've done is beat up the donor class of the political party, all the tech giants. So pretty comical if you are watching this political catastrophe roll out for Mr. Biden. But what's more important? Again, let's put politics aside. We just want to make money. The bond market's now recovering. That's essentially what we were concerned about. That's what we've been warning about for months. And all of a sudden, we got that bond market shock. It's came. It appears to be over. We'll take a look at those interest rates, especially the 2-year, and it is falling. It is now below 1, which means all this forward guidance of 4 rate hikes could be reduced as the 2-year is coming back down. The NASDAQ, Bitcoin, and Ethereum aren't just at critical levels, they are below critical levels, way below 200-day moving averages. We actually got the Russell 2000 positive on the day, another great leading indicator that we are at the bottom. Meanwhile, big money is gobbling up these assets. Okay, the greatest wealth transfer in history has been going on for 2 years, and there's just nowhere else to place your money. Banks, Google, Intel, everybody is getting their hands in on the crypto. And meanwhile, they're trying to prevent you, the retailer, from getting involved with all sorts of shenanigans. I truly believe in 5 years or less, we'll be seeing a $12,000 print on Ethereum, which is our favorite cryptocurrency, because it's actually getting massive use. It is ripping off the financial system successfully in DeFi and growing very, very rapidly. Now, important date is March is the 2-year anniversary of the lockdown where we had negative oil. Okay, so that's likely going to be the hottest CPI print. And after that, it's going to fall starting in April. Now, it could hit a high CPI sooner because we need to understand the stimulus ended last February. And so all of this free money the government passed out is slowly but surely being spent. And now the economy needs more fiscal support. So when growth is slowing, rates go down, you want to be long growth assets. And we are positioned heavily just for that to occur. So my expectation is peak inflation on the CPI by March, maybe sooner, but certainly by March, and it falls in April. I expect Build Back Better bill to pass, as the CPI flatlines, probably in April. Okay, so timing wise, we most likely want to be betting big on growth assets until the Build Back Better bill passes. Once that occurs, we should rotate into a heavier value position, which will be your NRGU. And we're going to expect rates to start rising once again as the massive fiscal budget gets passed. And again, we're going to have more and more pressure on bonds. If we take a look at our track record, Safe Growth delivered a 25% return 2021, and we were down 4.7% this morning in January. And again, I think that might be improving as the market is rebounding as we speak. The SPY, which was down, I think up to 3% today, only down 0.74%. Now we've had a lot of head fakes. We've had the SPY go positive in the day only to crash at the close, but today we're getting the opposite. Now our high risk strategy is trying to triple your money every year. So that comes at the cost of having to stomach volatility. It's had a 25% drawdown December, 9% drawdown in January. What I would be doing is rotating money out of my safe strategy into the high risk. I believe this is a very good time to make that move with the 70-30 portfolio. All right, let's review the key macros. Congress increased the debt ceiling by $2.5 trillion. This is highly correlated to stock valuations. The more debt the US consumes, the higher the stock market goes. $2.5 trillion is sufficient to keep this party going. They just need to agree on how to spend it. And a handful of senators are holding it back, wanting to see the inflation come back down. Okay, so, and I do think that is on track. Meanwhile, corporations still have access to cheap credit. Credit markets are not in trouble currently, and this is going to deliver trillions in corporate stock buybacks. We had a low December labor growth, 200,000 jobs added instead of 500,000 anticipated, and likely it will stay low until March. So this is the perfect setup for interest rates to fall and for growth assets to rebound. So this is what I look at. Where else would you put money? Cash is trash. Governments globally are spending more money than they make. This is due to a demographic phenomenon that is almost irreversible. Bonds remain garbage. Okay, the 30-year Treasury needs to hit a range of 2.5% to 3%, while the CPI is at 7%. So what I believe we're going to see is the CPI starts to slowly but surely fall towards 3% over the next 24 months as bond interest rates slowly but surely rise on the long end to that 2.5% to 3% range. And that'll be a great time to go long bonds. But right now you still have cash being devalued. You've got inflation running hot. Now I'm expecting inflation to slow down and fall, not to reverse. So we're still in an inflationary environment that's not good for bonds or cash. And so investors still have no other logical option. Everybody can panic and go to cash for a short period of time, but I believe the money will go right back to the assets that are likely to appreciate in value in this environment, which remains stocks, cryptocurrencies, commodities. We just want to have the right ratios until this bond market becomes attractive. And I believe it's a long ways off before that's going to occur. Again, we need that CPI to fall towards 3 and the 30-year Treasury to rise to 3 before that will become a beautiful buy signal. Our greatest fear in this environment is actually a robust labor market recovery that would reinforce the Fed having to tighten and reinforce these inflationary imprints. Now, they love to brag about a low unemployment number, but the reality is the labor force participation rate has lost 4 million jobs. So the economy is just not recovered. And with the sell-off in stocks and potentially a sell-off in real estate, people who thought they could retire on their stock portfolio may start to get back to work. So that's going to remain something we need to carefully monitor. What else could go wrong with my predictions? If the PPI and CPI don't slow down, then the Fed will have to hike rates into a recession, into a crashing stock market, and we will have a massive crash. I just don't think that's the case, and we have ample data to show that all of these metrics are slowing down and slowing down rapidly right now. So that's why it's critical you watch our Monday, Wednesday, Friday to be webinar to be ready for our next trade alert. And again, I believe the next trade alert will be essentially to rotate back into NRGU, take profits on Ethereum, and at some point reduce our crash insurance hedge, possibly as soon as this week on UVXY. And I would dump UVXY down and get more aggressive in ETHE. Soon as we get confirmation the Fed's going to back talk all this hawkish talk. Now, if anything does go haywire, we're protected. UVXY does great when you get limit down days, acceleration in stock crash. Last time we had a massive crash in March of 2020, UVXY went up over 1,000%. Now it's important. It doesn't do complete protection in the initial part of a sell-off. So we can look in March, in the first 2 weeks of the crash, it had only gone up 300%. But it was that last 2 weeks where it jumped from a 300% return to 1,100%. And so it's all about that VIX term structure, which is perfectly set up for massive profits if there's more volatility. And you saw that today. When you started that serious pain on the S&P 500, we were finally seeing that 25% gain intraday on UVXY. So it's positioned now to really do well. Again, I don't think the big crash is here today. It's too early to tell if the inflation is really going to be sticky or if it's going to top out and fall. And that's why I really recommend you do get positioned right now. There's certainly blood on the street, lots of margin calls and liquidations, and the big money is really not moving. So now may be the best time to get positioned. And I like to have 30% of our capital long the high risk growth strategy, and then 70% long your safe growth strategy. Now, big picture, I am expecting an inflationary cycle with rising rates, similar to that of 2008 to 2015. So energy will be critical to hedging our portfolio during this cycle that we're headed into. I'll be much more bullish on energy like we were much of last year, as soon as the Build Back Better bill passes. And again, I think the timing on that will be around April after we get the CPI falling. Now, if the PPI and CPI start falling sooner and Joe Manchin starts chirping the right way, we can certainly move in on that sooner. At this point, I want to see Exxon sell off and oil sell off to rotate us back into NRG. And it's really nice to have our inflationary hedge oil delivering a profit while the other energy products are getting hit. Now, this screenshot just reminds us of our overall theme and strategy. The yellow line are interest rates. Okay, the green line is XLE, the energy ETF, which we call value. And then we have the NASDAQ, which represents growth. And the trend you need to notice is that if interest rates rise rapidly, energy stocks go up, tech stocks go down. In other words, value goes up, rising rates, and growth stocks get hit. Now, Ethereum and Bitcoin are 100% a tech stock in terms of how they react to interest rates. So it's very important to have a robust strategy that protects us against these risks. So we had interest rates rise rapidly, almost shockingly, and now I believe they're going to do the exact opposite, flatline and fall until more fiscal stimulus comes in. Now, don't forget that there are 3 spots available per day to upgrade your portfolio. You can only get that if you call Dean at 505-322-7515. I do see some trade alerts coming in. First one will be to take profits on the relative jump in UVXY. Then we'll be looking at adding that to Ethereum. or Bitcoin in the 2 portfolios. And then after that, we'll be looking to take profits on BOIL and get back into NRGU. So that's kind of the sequence of trades. And once that Build Back Better bill is passed, we want to get heavier in value relative to growth. Okay, so that's big picture. Let me go ahead and jump into the data now. And okay, so very good. Let's just look at a few economic data points. So the market is freaking out that the Fed's going to end QE and hike interest rates rapidly. That's essentially what the media outlets have been giving us hints at. Meanwhile, what's actually happened? The Fed's balance sheet hit a new high and is quickly approaching $9 trillion. Okay, so is this market move overdone so far based on what's actually happened with monetary policy? Yes, I believe yes. Okay, ECB, the other big central bank, just hit a new high in its balance sheet. And they're not saying they're going to do the same policy as the Fed because their inflation is lower. Okay, so that's good. Now let's look at producer price index. This is critical. This really needs to slow down and fall. Now with China locking down port after port, that's questionable. So we have to keep a close eye on that. We have some data that would make me think this is peaking. Okay, so this leads the CPI. We've had it continue to rise. This absolutely needs to slow down and top out. So we'll be keeping close track of that. The next data point is the core inflation rate. Here's what I'm looking for. This needs to not necessarily stop rising by March. What we want it to do is to have smaller rate of change. So in the last print, we rose from 4.9 to 5.5. That's a 0.6 differential. I'm looking for this to jump no more than 0.6 in the coming months to signal that the inflation is peaking out and will start to flatline and fall by April. If we get that, it's going to be the perfect environment for the Fed to kick the can down the road and slow down the hawkish policy. And remember, the Democrats are headed towards potentially a disaster in midterms coming up this winter. So you go put the US in a recession ahead of midterms with sticky inflation. I don't think that's going to bode well. So they are walking a tightrope currently. Initial jobless claims just rose to levels we haven't seen since last October. That data, not good. Housing sales dumped last month. And the jobs, the non-farm payrolls came in less than half of what they're anticipating. Okay, so again, they like to say unemployment's super low, but the problem is the labor force is significantly lower, and we're short 4 million jobs than post-lockdown. So this is just not a good opportunity to tighten monetary policy, as the reality is everything is slowing down. Now, the only saving grace on the reflation side and the growth side is we are seeing large growth in loans from banks. Okay, so we're very early cycle in loan growth, and we're also seeing massive growth in consumer credit. So this is good for the stock market as well in this environment. Meanwhile, are we really seeing a global crash in growth? I don't think so. If I look at Chinese imports, still at record levels, as well as exports. Okay, so that's the backdrop overall for the market. Meanwhile, to be very fearful that the bond market's about to really crash, the reverse repo should fall. as those interest rates become more and more attractive in the open market. It's still elevated 1.6 trillion. Last week we had a 1.7 trillion print. Okay, so that's bullish. Next, let's take a quick look at interest rates. And then we'll look at stocks after that and commodities. All right, so the pain in the market, in my opinion, is primarily from the 2-year going up from 0.1 in October to over 1% just a week ago. Okay, so this is essentially controlling what the Federal Reserve does. And this sudden move gave the forward guidance that we're going to get 4 rate hikes. This is now dropped. Okay, we're seeing all the bonds drop in yield, the 30-year, the 10-year, and the 2-year. What will be the catalyst for it to go higher? I believe it will be the passage of the Build Back Better bill in April. So if I'm right, these interest rates are going to either trade sideways or down, and we're going to see a lot of money flow right back into technology stocks, including Bitcoin and Ethereum. So we're going to keep a close eye on it. If this starts to move higher and oil does not stop rising, we will have to re-examine our forecast for the next 3 months. So far, though, we do appear to have oil stuttering out, and we have these yields starting to fall. And as far as worrying about the Fed, we really care mostly about the 2-year here in terms of predicting what policy they're going to push. All right, let's take a look at oil against interest rates. This is what has me the most concerned about predicting the Fed. They want that price of oil to drop. This is going to help get the CPI down, take a lot of political pressure off of Biden, and help them pass that Build Back Better bill. So what have they managed to do? Crash the stock market, and oil has barely budged. So that remains problematic. So we'll keep a close eye on oil. Now, what has led the price of oil? We are starting to see yields fall, not a whole lot, but this would signal oil is going to come down here. Next, let's look at some other futures products. So let's look at copper. Copper is clearly in an uptrend, but it's been trading relatively sideways, so no big clear signal here. It did jump and then fall right back. The Baltic Dry Index, probably the most bearish signal we have with predicting that oil prices will come down. This is cost to ship commodities between various continents and has been falling. So this is a good sign for us being long growth currently. And we're starting to get a little pullback in lumber futures. Now, lumber futures, I was very convinced the price of oil was going to go considerably higher last year. And it had started to earlier in the year and then fell through the summer. And lumber futures had warned us of the fall before it occurred. And it was an epic crash in lumber futures right here in the candlestick. Since then, lumber's been recovering and warning us of the opposite. So far, we're getting a little pullback in lumber, but again, it's not falling off a cliff just yet. But again, the Baltic Dry Index, the yields falling, lumber futures falling, copper staying in trend but not crashing, are all telling me we're likely about to have a reversal of what we've just gone through. So that would mean rates fall and a big bid in tech and crypto. But if we're wrong, we're looking at natural gas as our inflationary hedge heading into to winter. So we'll take a look at that against the oil play in a minute. All right, here's 2 inflationary hedges we're using currently. We did sell NRGU and are waiting for it to go down. and we're using the cheaper, at least relative to recent high, oil to hedge against further inflation and interest rate spikes. And so oil's been doing pretty well here. It's been volatile. It's a very volatile asset. And we can see how correlated it is. So we're starting to see a big bid in NRGU just in the last hour, and oil's been going up consistently through much of this volatility. So it's doing a great job at protecting the portfolio. Okay, in this chart, we are now looking at interest rates, the NASDAQ, and the energy sector with NRGU. And so what are we seeing here? Zoom out a little bit. We can see how energy just loves to follow the yellow line up and down. Again, that's our interest rate hedge. Then we can see the inverse correlation between the growth stocks, tech against the yellow line. In general, if the yellow line's going flat or down, money is flowing into growth. And if the interest rates are rising, money's flowing predominantly into energy. So if we look at this December move that was so negative for growth stocks, we can see the general trend where interest rates rose and tech stocks took a bloodbath. Now our interest rate's going to keep rising in a slowing economy. I highly, highly doubt that. Not unless the Federal Reserve forces them to with extremely hawkish monetary policy. Which again, I think we're going to get a dovish surprise on Wednesday because we're 11 months now with no fiscal stimulus, and all of the data is coming in with a deacceleration of growth. So it's a very bad time for the Fed to try to pull this off. And inflation may start to fall on its own now. Now, if you're in the safe growth strategy, we did take a lot of money off the table in US stocks and rotate it into emerging markets. And the theory here was really two-part. One, the emerging market index had sold off for an entire year. So that was one. It was a much better value play from that respect relative to US. So the thought process was, one, China is likely going to start increasing credit in its economy as the US is going to slow credit. Two, if the market's going to fall, quite likely less pain in emerging markets relative to extremely perfectly priced US equities. And if we're going to go up from here, better returns for emerging markets. And that seems to be playing out quite beautifully in the short term for our safe growth strategy. Okay, let's take a look at this Russell 2000. That was the biggest bear signal we had last week because it broke out of this channel to the downside. Now, to be fair, there's a lot of junk in the Russell 2000, like GameStop and AMC, a bunch of businesses that are essentially dying dinosaurs getting replaced by growth stocks. So we got to take that into respect. But it's getting a big bid today, and it will be important. So we'll keep a close eye on that. I expect it to get back into its channel range in the near term. If it continues to fall, perhaps we get more defensive. European stocks finally broke below its channel. Again, this is going to be a very bullish product in a rising interest rate environment, but still hanging in there. So no change to our EFO position, which we're playing with EFA. That's relatively our smallest position once you calculate the leverage, because it's only 2 times leverage. So we're relatively light on Europe compared to the rest of the portfolio. As soon as the Build Back Better bill passes, I would consider a heavier position in EFO because that would drive rates higher, and this index really likes rising interest rates, as does emerging markets. All right, the dollar index, with all this crashing, it's global. So all currencies are getting a bid. We're not seeing the dollar skyrocket, and we're not seeing a huge bid on treasuries. So all this pain in the market, but money is not fleeing to the dollar or to treasuries to signal this is a massive risk-off event. And as we speak, looks like all of the indexes have turned positive on the day. And I'll be damned, we might actually have a down day on UVXY after it was up 25%. Truly remarkable moves in the market today. Another ticker we've been watching is the Turkish lira, which I believe is causing some pain in specifically crypto markets. It's stabilized, no sign of problems there at this point. No problems coming out of the Chinese currency. It continues to strengthen. Let's see what we've got in tech land today. Let's zoom in on a 30-minute chart. Actually, we'll go to an even shorter time range. Wow, look at that bid. So NVIDIA was down a lot. So the rebound today, we have money flying into NVIDIA up 11% over the last, what is that, 3 hours. Tesla up 9%, Microsoft up 7%, Amazon 6%, Apple 4%, Google 4%. Now, these are some of the non-tech companies that are massive market cap in the S&P 500. And let's see what kind of bids we're getting here. So these are more of the value-based companies. And notably, Berkshire Hathaway is barely having any pain at all during this crash. And he's been sitting in 30% cash. I wonder what he's been buying. Probably, I'm going to guess, a bunch of Apple with that huge stockpile. But again, where are we seeing the relative outperformance in this rebound? Is it in growth or is it in value? Clearly, it's in the growth stocks. These value companies are only up 3%, 2.5%, and 2%, with Bank of America, Johnson & Johnson, United Healthcare, Home Depot, JP Morgan. So yeah, I think now's the time to have that growth exposure. Now over in Asia, we are tracking 3 companies. Taiwan Semiconductors, perhaps the most important company in the world over the next decade, probably will be the cause of a major war if the United States remains independent, which is questionable. But let's look at some of the leaders out of China. Tencent down 21%, Alibaba down 54%. But they've been stabilizing and getting a bid during all this volatility, and actually up starting from December, which is not the case for almost any other tech company. So if we go back to December 6th from that low, you can see Alibaba's up 7%, Taiwan Semiconductors up 5%, Tencent up 4%. And this is while a lot of other tech giants have been smashed. So again, showing that strength in emerging markets in this new cycle. Now out of Europe, I'm primarily watching Toyota, ultra strong. So again, I would love to add to that position as soon as we get the right catalyst in place. Here's Exxon, which we're using to time NRGU. The price of oil is impressive with this crash. I honestly would have thought we would see more downside in oil by now, because I believe all of this was orchestrated to do just that, to get inflation down, to pass the Build Back Better bill. It's barely nudging. So we're going to be patient to go long energy, specifically the oil and gas companies, and keep a close eye on that. I'd love to see Exxon fall towards 65 to begin aggressively buying NRGU again. So we'll just have to keep a close eye on that. Okay, are we predicting a recession with the yield curve? This would need to go below 0 for that to occur. It's been heading the wrong way for quite some time. which means the yield curve has been flattening and could invert. It's still a long ways off. So for this to really fix itself in terms of predicting strong economy, we want the 2-year to come down and the 30-year to go up, making this spread widen. And that would be very healthy. The bank credit growth really signals that should happen. We just need to get that most likely more fiscal support to help drive that. And at the same time, inflation to fall. So we need inflation to fall and more fiscal to come through, and continued expansion of credit from banks. And I think we'll see that that Treasury spread go the right direction for a healthy economy. Okay, let's see what kind of damage we're seeing in credit markets. Let's see what we can get for the biggest decline if I zoom out. So I think we got a peak right about here. Okay, so the biggest damage we've seen to credit markets most likely is from this point, July of 2021. We can see junk bonds have sold off 2.5%. That's nothing. TLT from this point's down 5%, and the investment grade bonds are down 5%. So just not a huge crash to freak out that credit markets are broken, which means easy capital for the government and for corporations. Government wants to flood the economy with money, and the corporations want to continue to do stock buybacks. All right, let me get to a much shorter time horizon on this one. So we're comparing Ethereum to Tesla now. One obviously sells cars, and the other is trying to replace the US financial system. But they trade very correlated, and it's looking like we've bottomed out. I believe we're going to see a big catch up from Ethereum towards Tesla. And so keep watching this every Monday, Wednesday, Friday. Boy, gold just does nothing this year or the last 12 months, and somewhat of a negative correlation to Bitcoin here. So very, very interesting. Not getting ready to dump Bitcoin for gold, as I believe rates are about to fall, and we're going to get a big bid back into Bitcoin. Now, the products we play, GBTC and ETHE, are trading way below the value of the trust. 28% discount on GBTC this morning. It may be less now, and a 22% discount on ETHE, which means if Bitcoin and Ethereum go up, you could easily outperform by about 20% or at least 15% until that discount window comes back down. Now, historically, the Grayscale Trust has traded at a premium. It's only since the big interest rate spike last March that it's begun to trade at a discount. So potential for even greater outperformance than just closing that discount window. So looking forward to adding to both GBTC and ETHE in the near term, most likely by reducing UVXY after we get better guidance Wednesday from the Fed. So expect a trade alert Thursday. Okay, again, the Treasury market would be a good hedge for us, but it's not. And you can see with this huge risk off day, TLT was barely up a little bit, and now it's down. Okay, why? Because like I said, the CPI is at 7, and the interest rate on the 30-year is way below inflation. The 30-year currently pays out 2.1%. So what I believe you're going to see is the bond market and the CPI go to one another and meet around 3%. And that will be a beautiful day to buy treasuries, which we will use the ETF TMF. As far as buying EUO, which is the dollar against the euro, we'll be looking for DXY to head to 90 to make that play. Currently, it's at around 96. So just not a good time to own the dollar. 95.8 on DXY. Not a good time to buy bonds or the dollar. Okay, the only hedge that makes sense is UVXY at this point, and still remains so. Okay, the futures market has been, in terms of predicting interest rate hikes, still had, wow, that actually went up a tiny bit from last week. This had dropped to 2. Right now, we're predicting a certainty of a 1 interest rate hike in March, and to taper the bonds through March. If that happens, I believe all the pain in the market's already priced in. What would be a surprise to the hawkish side would be to end QE earlier and to do a 50 basis point rate hike. That's not priced in. Neither of those events would be priced in and would be negative for risk assets. If they stay course with what is priced in, I believe we are really well positioned and can soon reduce our UVXY hedge, rotate it into GBTC for safe growth and ETHE for high risk. All right, let's take a look at our yield curve. Boy, oh boy, it's a bad looking yield curve. They want it to slant like a ramp, and they want this 2-year to come down, signaling the inflation is falling. And they want the long end to go up, signaling there's lots of growth and credit creation ahead. And they want this to not be like a hill, but like a ramp. So let's go back in history to see where we had a nice looking one. Funny enough, it was right before Trump passed $1 trillion and Biden passed $2 trillion and overstimulated the economy. So this is the shape they want it to signal a healthy economy and yield curve for banks. And what they have is not that. Okay, now this would be more troublesome if any dot to the left goes above any dot to the right. So we currently have an inverted 20-30 year, which I don't make much of. But if the 2-year goes above the 10-year, that's what has predicted stock crashes and recessions. Typically what happens is the yield curve inverts, then the long end goes up, and then the interest rates break the markets. And it takes about 12 to 16 months after a yield curve inversion for everything to play out. So far, we don't have that. Let's take a look at the VIX futures. So this is exactly what you want for a massive gain in the UVXY. You want the front end to be above all the dots to the right. And that's why you're able to see that 25% intraday return. If there's any more pain in the markets, UVXY is positioned to go parabolic. We're absolutely positioned to cash out UVXY if there's further pain and buy the dip with the proceeds, assuming the Fed makes some sort of policy mistake and causes another big leg down. I don't think that's coming, but if it does, the VIX futures structure is perfectly aligned for massive gains ahead. And again, I don't think that's what's coming. Otherwise, I'd be getting you into treasuries and the dollar and getting out of the way. But again, all of this reaction is to events that have not yet occurred, predicting super hawkish Fed policy in a slowing economy. All right, in this chart, we're just looking at some of the competing cryptos. I'm worried for all of Ethereum's competitors as they switch to proof of stake here probably this summer. Let's see who's getting hit the worst. Solana down 51%, AVAX 45, Polygon, which is the beautiful partner to Ethereum, very bullish on that, down 42, Ethereum down 40, Polkadot down 37, Binance Coin down 31, Bitcoin down 26, Cardano down 25. Okay, so our bet is you want to be long Ethereum, and if you want a more aggressive partner in crime to Ethereum, you go long Polygon. Those are my 2 picks for the greatest return risk in the near future. Okay, let's check out the news feed. Okay, let's see. I'm looking at some questions. Iberman says, I'm still holding a lot of oil stocks. Are you saying I should sell? Well, I would follow the portfolio, Iberman. I have everything very carefully set up so that you don't have to worry about that. But yeah, there's very specific ratios and proportions to the way I position our clients. And so uh, basically, I think you should be twice long growth relative to value at this point. So I'm not saying you should have no, and again, I think you should be long natural gas spot price as a smarter hedge in the short term to hedge against inflation relative to oil stocks, which just had a massive gain and are quite likely to have more pain to the downside than Boyle. So we like Boyle currently to hedge against interest rates. In general, I only use energy to hedge growth. I really think the future is technology, and demographics are going to really ensure that this environment remains intact. So we hedge our growth with energy. AA says, just joining in, how do you calculate how much? Yeah, so you just punch in the number in our membership area, AA, and it tells you what to buy and sell. If you're on a free trial, you get that in a screenshot. So just do what the calculator tells you, and you're going to be set to jet. But yeah, I'm the one controlling those ratios, and they're very carefully chosen. So makes your job super easy. Just punch in how much money you want to invest and let the calculator do the risk, do the calculation for you, and you go buy your list of stocks, and then you wait for trade alerts. Okay, Zero Hedge says odds for the next CPI print is a shockingly big miss. We will see. He's just kidding that perhaps we're gonna back talk all this hawkish talk. We will see. Let's see what comes out Wednesday. NVIDIA 40% off sale all the way down to 19 times 2022 sales. That's was actually rebounding the most today. Christopher Broad from Bloomberg says market has never plunged 10% this fast to start a year. Lynn Alden says during the February-March 2022 crash, Bitcoin topped early and bottomed early compared to the S&P 500. Lots of false signals, and Ethereum was bottoming out before stocks this morning. Here's the discount window. So this just means the amount of Bitcoin Grayscale Trust GBTC owns relative to its price per share is at a 28% discount. So this is actually turning into a relatively leveraged play now. I guess about a 30% leverage in it, because you're going to lose more on the downside and make more on the upside. So funny how that's playing out. 22% discount on ETHE currently. Peter Schiff says not only was the US economy already headed into a recession prior to the Fed announcing its plan to hike rates, but the reverse wealth effect that will result from the crash in stocks and cryptocurrencies and associated margin calls will make the recession that much worse. David Rosenberg says only once in the 10 bear markets in the Russell 2000 did the Fed dare to tighten into a drawdown, and that was late 2018. Oops. What's interesting is that the next move is either a pause or a policy easing in all 10. Could the rate cycle be over before it even begins? Now he's a perma Treasury bull, just to be fair with how to look at his analysis. But I agree. I believe that's what's coming next. We will have better confirmation on Wednesday. ARK went and removed the year-to-date return on their website. Almost comical, but Bets on the 10 basis point ECB hike pushed back to December from October. Next up, the Fed zero hedge comments predicts. Epic crash in Moderna. Now we bought this at 30, sold at 90, watched it melt up to 500, which was nuts. And now it's down to 206. I was just telling us perhaps the lockdown mania is coming to an end. It is been thrown away in the UK, and I believe it's going to quickly reverse course here in the US because everything they've promised us has failed. And so we will see. But this should help the labor recovery, which again is not our best friend on the growth side. Mohammed El Arian thinks the Fed should say they will immediately end QE on Wednesday and do at least 25, perhaps 50 basis point hike March. But he doesn't think they'll do it. So it's even Savon Henrik, a pretty bearish type of fellow, thinks this has been overdone now. We're at this critical bounce level. Lance Roberts, another bond bull, says the Fed won't hike rates nearly as much as the market expects, as the yield curve is already flattening, along with expectations which suggest inflation won't be a problem for very long until they pass the Build Back Better bill. I actually agree. We've got a lot of tech reporting coming in this week, Apple and Microsoft, as well as Tesla, and then some value with MasterCard, Visa, and Johnson & Johnson. So we'll see how that plays out. Zero Hedge says what happens in markets in the next 2 to 3 months will depend on a big clash emerging on Wall Street. So we got Morgan Stanley hyper bearish and JP Morgan hyper bullish, who say inflation is too high, the Fed will keep hammering stocks, and those say the economy is slowing down fast and the Fed will turn more dovish. The inflation and hammering is more priced in, obviously, at this point. Let's see, Live Miner says, God help shorts. If Powell says no rate hikes until summer, there's a massive short position in the market this morning. This is the guy who created Uniswap, just had his bank accounts shut down. Certainly, the banking cartel is trying to make it hard for the average Joe to get out of the US banking system. We're seeing this really dramatic. Hayden.ethe this week, JP Morgan Chase closed my bank accounts with no notice or explanation. I know many individuals and companies who have been similarly targeted simply for working in the crypto industry. Odds on the midterms are extremely slanted for a sweep. We'll have to react to that with policy. As far as policy later in the year, if that remains the odds, we'll judge that more as we get closer. Okay, very good. That's really the critical items I wanted to hit. So we're about to review asset allocation. Before that happens, if you're catching the replay and your free trial is expired, this is where you end the video. You don't get the exact formula for how to invest. So make sure to upgrade and get all of our trade alerts coming out